When most people start trading with $100, their mind instantly shifts into get-rich-quick mode. They imagine doubling their account in a week, maybe hitting $1,000 in a month, and before long, they're dreaming of quitting their job. This mindset is the exact reason most fail. Turning $100 into $1 million is not about speed. It is about the ability to think in decades, not days. The mindset that makes this possible is called the compounding mindset, the belief that slow, consistent, and strategic growth beats fast, reckless gains every single time. The compounding mindset is rooted in patience, discipline, and long-term vision. It's not glamorous at first. It doesn't give you the adrenaline rush of placing huge bets and watching your account swing wildly. But it's the same mindset that built fortunes in every industry, from Warren Buffett in investing to Jesse Livermore in trading. This is the thinking pattern that forces you to protect your capital, grow it steadily, and never sabotage your own progress. The average trader sees $100 as nothing, something they can afford to lose. The millionaire trader sees $100 as a seed. You don't eat the seed. You plant it, water it, and protect it. If you're constantly digging it up to see if it's growing faster, you'll destroy it. In trading, this means resisting the urge to overtrade, to risk too much, or to jump into random setups because you're bored. The $100 account demands respect, because how you treat the small amount is exactly how you'll treat the big one. Consider this. If you can grow your account by just 5% per week, that's not exciting in the short term. On $100, that's only $5 in profit. Most traders would laugh at that. But over time, the math becomes shocking. At 5% weekly growth, $100 becomes about $10,000 in less than 5 years. And if you can keep the same mindset with bigger capital, the numbers explode into hundreds of thousands and eventually millions. The principle is simple. Growth multiplied over time creates results that seem impossible at first. The problem is, most traders fail to think this way. They want to take their $100 and risk 50% on a single trade, because if they win, they're instantly up $50. What they don't see is that if they lose twice in a row, their account is nearly gone, and their emotions are destroyed. This is where the compounding mindset separates the winners from the losers. Millionaire traders never measure success by one trade or 1 week. They measure it by a series of disciplined actions over months and years. Take the example of Richard Dennis, the famous commodities trader. In the 1972nd, he started with a small amount around $1,600 and turned it into hundreds of millions over the next decade. He didn't do it by gambling. He did it by applying consistent, repeatable rules to every trade and letting time do the heavy lifting. The story isn't about luck, it's about disciplined patience. That's the mindset you need, even if you're starting with less than 1% of what Dennis had. Compounding mindset also forces you to view losses differently. Most traders panic when they lose money because they see it as a setback. But a trader with this mindset knows losses are part of the game, and they're calculated into the plan. If you lose 2% of your account today but you stick to your strategy, you can make it back over time without taking excessive risk. This emotional stability is critical. If you let one bad trade push you into revenge trading, you've already lost the mental game. Now, let's talk about emotional energy. Trading isn't just about charts. It's about your mental state when making decisions. If you're chasing quick money, you're in a constant state of anxiety. Every small market movement feels like a life or death situation. You can't think clearly. The compounding mindset eliminates this by removing the pressure to get rich right now. It shifts your focus to make the right move consistently. This not only makes trading less stressful, it also improves decision-making quality. A common mistake new traders make is comparing themselves to others. They see someone on social media flipping $500 into $5,000 in a week and feel like they're doing something wrong. What they don't see is that those traders are often taking massive risks, and many of them blow up their accounts soon after. The compounding mindset ignores the noise. It's about building your own journey, at your own pace, with rules you can stick to no matter what the market does. For example, imagine you have $100 and your goal is to make 3 to 5% per week. You have a solid strategy that gives you 2 to 3 high-quality trades per week, each with a 1 to 2 risk-to-reward ratio. You risk 2% of your account per trade. So on $100, that's $2. If you win, you make $4. This seems small, but after a few months of consistency, your account begins to grow. At $500, you're making $10 per win. At $5,000, you're making $100 per win. The process is the same, only the zeros change. This is the core principle that turns small accounts into large ones without blowing up in the process. There's another hidden benefit to starting small with this mindset. It forces you to master the skill of risk control before you have big money on the line. Too many traders get a sudden influx of capital, maybe from savings or a prop firm, and blow it in weeks because they never learned how to handle small amounts properly. By respecting your $100, you're training yourself to respect $100,000. It's the same game, just a bigger scoreboard. You also need to understand that the compounding mindset is not passive. It doesn't mean you sit back and hope your account magically grows. It means you are actively refining your strategy, learning from mistakes, and adjusting to market conditions, but always within the framework of controlled risk. You're not trying to hit home runs. You're trying to get on base every day, and over time, those base hits add up to a championship season. Some traders resist this approach because it feels slow, but ask yourself, what's better? Spending 6 months chasing quick wins, blowing up multiple accounts, and ending up back at zero, or spending those same 6 months building a track record of consistent growth so that when bigger capital comes, when you're ready? One path gives you quick dopamine hits and long-term frustration. The other gives you discipline, confidence, and the potential for real wealth. Let's also be clear. The compounding mindset isn't just about money, it's about identity. When you adopt it, you start seeing yourself as a professional, not a gambler. Professionals think in terms of systems, probabilities, and long-term goals. Gamblers think in terms of luck, hunches, and one big win. The market rewards professionals and punishes gamblers. Your $100 is your training ground to become the kind of trader the market respects. In the end, the compounding mindset comes down to this: protect your capital, grow it steadily, and never rush the process. If you can master this with $100, you've built the mental foundation for turning that into $1 million. The numbers may change, but the mindset stays the same. And once you truly internalize this, you'll realize that the small account you're trading today is not a limitation. It's your greatest asset. In trading, patience is not simply the ability to wait. It is the ability to wait without destroying yourself in the process. Most traders think they are patient because they can hold a trade for an extra 5 minutes, or because they can sit through a small pullback without closing early. But ruthless patience is different. Ruthless patience is when you can stand in front of the market, watch the price dance just inches away from your dream entry, and still refuse to pull the trigger because the setup is not perfect. It is when you can see the market tempt you with movement, with volatility, with the illusion of opportunity, and still you do nothing because you understand that not trading is also a trade. This mindset is rare because the market is designed to trigger impatience. From the moment you log in, every candlestick is an invitation. Every tick of price is a whisper telling you to act now, before it is too late. And if you are not ruthless with your patience, those whispers will become commands, and you will obey them. A trader with no patience will find trades in every movement. A trader with ruthless patience will find trades only when the odds are heavy in their favor. I remember reading about a trader in 2003 who had a rule. He would only take a maximum of 4 trades a month. Not because he was lazy, but because he understood that his system only produced 4 high-probability setups in that period. 1 month, he waited 23 days without placing a single trade. On day 24, his signal appeared. He entered, managed the trade perfectly, and made more in that one position than most impatient traders made all month combined. When interviewed, he said something that has stayed with me ever since. If the market will still be here tomorrow, why should I rush today? That line contains the essence of ruthless patience. The challenge is that patience feels like doing nothing, and doing nothing feels wrong when you are supposed to be working. Our brains are wired to associate productivity with activity. In an office, you type emails, attend meetings, make phone calls. In trading, the most productive thing you can do is sometimes to stare at the screen and take no action at all. This feels unnatural. Your hands itch to click. Your mind convinces you that any movement is better than no movement. And so you break. You enter too soon. You chase. You trade setups that are almost valid. You sabotage yourself. Ruthless patience is not passive. It is active waiting. It is a conscious, deliberate choice to protect your capital until the exact conditions you require are met. This requires mental strength, because the world rewards speed, instant results, and quick wins. Trading rewards the opposite. In the market, the tortoise doesn't just beat the hare blows its account, while the tortoise compounds slowly into freedom. There was a legendary commodity trader in the 1982nd who made hundreds of millions of dollars, but only traded about 15 days out of the year. People assumed he had some mystical edge. In reality, his edge was discipline. He knew his setups so well that he could identify exactly when they appeared. On every other day, he simply did nothing. He described the waiting as boring as watching paint dry, but when the trade came, it was like stepping in front of a moving train with perfect timing. That's ruthless patience. Waiting for the train you know is coming, rather than running after every shadow. To develop this mindset, you have to redefine what winning means. Winning is not making money every day. Winning is following your plan every day. If your plan says you only trade when certain criteria are met, and you see nothing that meets those criteria, then not trading is a victory. The impatient trader measures success in pips and dollars. The patient trader measures success in avoided losses and preserved mental capital. This is a subtle but powerful shift, because it removes the pressure to force trades. Think about the psychological damage impatience causes. Every premature entry that turns into a loss chips away at your confidence. Every unnecessary loss forces you to trade harder just to get back to where you started. And when you trade harder, you often trade worse. This is the spiral that destroys accounts. Ruthless patience stops the spiral before it begins. It is a shield that protects you from your own worst instincts. Of course, ruthless patience is not natural. It must be trained. It starts with clarity. If you do not have a clear, well-defined trading plan, you cannot be patient, because you won't know what you're waiting for. The mind hates uncertainty, and without a plan, it will convince you that any opportunity is good enough. When you know exactly what a perfect setup looks like, you can reject everything else with confidence. The clearer your rules, the easier it becomes to sit through the noise. In 1995, a futures trader named David H. was mentored by one of the best pit traders in Chicago. The mentor told him, "If you can stand on this floor all day and make 0 trades, you're ready to be a pro." At first, David thought this was a joke. Why would you be a trader and not trade? But after blowing his account twice, he understood. The mentor wasn't teaching him to avoid trading. He was teaching him to avoid bad trading. That year, David focused on waiting. He let dozens of potential trades pass. When his exact setup came, he executed with precision and size. By the end of the year, his win rate had improved by over 40%, not because his strategy changed, but because his patience did. The real test of ruthless patience is during drawdowns. When you're losing, the temptation to make it back quickly is overwhelming. The impatient trader doubles down, chases high-risk trades, and tries to force the market to give them what they lost. The patient trader accepts the drawdown, steps back, and waits for the same high-quality setups that got them profitable in the first place. This is counterintuitive, but it's why the patient trader survives and grows, while the impatient trader burns out. Patience is also the foundation for scaling. Imagine you do have that $100 account. If you are impatient, you might turn it into $200 quickly, but then back down to $50 just as fast. If you are patient, you might only grow it by 5% in the first month, but that 5% compounds. Over time, your small, steady gains build a stable base that can handle larger positions and bigger opportunities. Impatience chases explosions. Patience builds empires. One of the hardest parts of ruthless patience is dealing with what-if moments. You skip a trade because it didn't meet your rules, and it ends up being a winner. The impatient part of your brain screams, "See, you should have taken it." But here's the truth. A good process will sometimes let winners go. That's not a flaw. That's the price of long-term survival. Your job is not to catch every winner. Your job is to take only the trades that fit your edge. The market will always offer more opportunities. Missing one does not matter. Breaking your rules does. Patience also affects how you manage trades once you're in them. An impatient trader cuts winners short because they can't stand the thought of price reversing. A patient trader holds for the full target because they trust the probabilities of their system.